Hey everyone, we are halfway down the Q4 result season and it's been a mixed set of performance so far. While the IT, FMCG and auto sector has witnessed slowdown in growth at broader level, financial sector and few pockets of NBFC segment have done well. Apart from this, there are many individual companies that have outperformed. But the challenge is that in spite of last many months of correction and consolidation, many high growth companies are still trading at premium valuation. For example, Persistent System from IT sector has posted excellent numbers, but it still commands a PE of more than 60. Army Organics, another company I track very closely, has posted excellent results but command a PE of more than 60. Netweb has another solid set of results and even the guidance is very good for next 2 years at 35 to 40% growth, but valuations are not cheap. Indian Hotel, another consistent set of high growth performance but still command a premium valuation. Likewise, Radico Khaitan from Elco Beverage sector, Latent View, Titan, Trent, Bajaj Finance, they all have posted very good to excellent results but still command a premium valuation. Honestly speaking, I track more than 200 quarterly results and there are very few companies today that are showing good growth at the same time command a fair valuation. In spite of some correction in last few months, majority of them are still trading at higher valuation. Companies where valuations are attractive are actually underperforming. Like I said, we are still in the middle of Q4 result season and many results are still pending. But I have tried to compile a list of companies that have posted very good Q4 results so far and have fair valuation. But before we discuss the stock names, please note that it is not a buy or sell call. The idea is to share my knowledge. Please make sure that you do your own research before investing your money. Alright, let's get started. So the first 3 companies in the list are from one particular sector. It's affordable housing finance. I've been tracking this sector for a while and even recently I discussed it. If you want to understand this sector, do watch that video. The biggest reason why affordable housing finance sector is doing well and should continue to do well is because in the near term, RBI has cut the interest rate. Now, majority of affordable housing loans are at fixed rate, which is fixed for 3 to 5 years. So when housing finance companies raise new fund at lower cost, much of their existing loan book is still at higher fixed rate. As a result, during the rate cut cycle, housing finance companies' margins expand and they earn more on the same loan. They might cut rates a bit to stay competitive, but most of the benefits stay with them. And that's how the profitability improves in a rate cut cycle. Then second short-term positive factor is liquidity injection by RBI. In last few months, RBI has pumped significant liquidity in banking and financial sector by purchasing bonds to boost the credit growth. It directly results in banks and NBFC with more money to lend. Hence, housing finance companies can grow their loan book at faster rate. And as far as long-term growth story is concerned, one of the biggest growth driver is urbanization. Even today, 65% of population in India lives in rural area. But there is a clear trend of people migrating from villages to tier 2 and 3 cities for better job opportunities, better lifestyle, and it's expected that by 2036, over 40% of Indians would live in urban area. So the demand for 10 to 25 lakh home loan would explode in these areas. On top of this, affordable housing sector also get pushed from government with schemes like PM Awas Yojana, where target is to construct additional 2 crore rural houses between 24 to 29. These schemes offer various subsidies. So all these factors would continue to drive the demand for affordable housing in India. So first company from this segment that has posted excellent number is Homefirst Finance. Homefirst has posted 31% year-on-year growth in loan book AUM in Q4 quarter. 15.5% growth in disbursement. Asset quality remains stable with gross NPA at 1.7%. Spread is above 5% level. Profit after tax has jumped 24.5% year-on-year. ROA is also good at 3.5% and ROE stood at 17%. That has actually improved by 90 basis points. Overall in FY25, Homefirst AUM has grown 31% year-on-year. Disbursement has grown 21%. Asset quality remains stable. Profit has grown 25%. Homefirst has recently raised 1,250 crore in QIP in April month. That included top FIs like International Finance Corporation, Capital World, Fidelity International, Y2 Capital, Goldman Sachs, and top DIs like SDFC, Aditya Birla, Invesco, ICICI Prudential, Bajaj, Kotak, etc. This QIP is also visible in latest April shareholding pattern where both FIs and DIs stakes are up. In fact, both of them have consistently increased their stake in last many quarters and public stake has reduced significantly. As far as future growth guidance is concerned, Homefirst management has given a target of 20,000 crore loan book by FY27. Please note that by FY25, company's loan book stood at 12,712 crore. So if company can achieve the guidance, it would translate into 26% CAGR growth in loan book. And management has also given a target of 35,000 crore loan book by FY30. So that would be nearly 3 times the loan book from current levels at 23% CAGR rate. Currently, Homefirst is trading at a price to book of around 4.1 and command a market cap of around 12,000 crore. Although valuations are not cheap, so there's a little scope for PE re-rating, but company should be able to deliver 25 to 30% kind of growth in share price based on the growth it has projected in FY26 and 27. Okay, before I move on to the second stock, I received a lot of requests on how to use AI in financial research. We all know that AI is quickly taking over every aspect of our life, including our jobs. But at the same time, it is creating massive opportunities for those who are learning and adapting into AI tools. In fact, personally, my Google search has gone down by 90%. Now, I mainly use AI tool for my financial research. If you also want to learn these AI tools, there's a free 2-day AI training conducted over the weekend. This AI training program is valued at around 10,000 rupees, but free for all of you thanks to our partner today, Outskill. This is not just any training, it's the world's first AI-focused education platform backed by top AI investors and pioneers. The program spans 16 hours of live training across Saturday and Sunday from 11 a.m. to 7 p.m. Link is in the description. In this program, you'll learn more than 20 AI tools to add to your toolkit, prompt engineering for fantastic results, data analysis without the need for coding, creating professional presentation using AI and Excel, building tools and applications with AI, no coding required, AI generated images and videos that will blow your mind, then developing powerful AI agents, automating tasks for maximum efficiency. This program is for everyone, whether you are in tech, sales, marketing, HR, operation, or even running your own business. So do check out the details in the pinned comment. Moving on, second stock in the list is India Shelter Finance. It has posted 35% year-on-year growth in loan book AUM in Q4 quarter, 25% growth in disbursement, profit after tax has jumped 39% year-on-year, ROA is fantastic at 5.4%, ROE stood at 16.3%, asset quality is also stable at gross NPA of 1. Overall in FY25, India Shelter AUM has grown 35% year-on-year, disbursement has grown 27% and profit has grown 53%. Company has been growing at a very fast rate with 40% CAGR growth in AUM in last 6 years. Currently, India Shelter is trading at a reasonable valuation with price to book of 3.6 and command a market cap of around 10,000 crore. Then third stock is Adhar Housing Finance. It has posted 21% year-on-year growth in loan book AUM in Q4 quarter and same 21% growth in entire FY25. Then 18% year-on-year growth in disbursement in Q4 and 16% growth for FY25. Profit after tax has jumped 21% in Q4 and 22% in entire FY25. ROA is fantastic at 4.3% in FY25 and ROE stood at 16.9%. Asset quality is also stable at gross NPA of 1.1 and net NPA of 0.7. Cost to income has also reduced in FY25, which is again a positive sign. Although Adhar housing growth is relatively slower than India Shelter and Homefirst, but it commands a relatively lower valuation with price to book of 3 and command a market cap of around 19,000 crore. Next two stocks in the list are from large cap space. I always say that it's important to have a few large cap companies in the portfolio because it's not just about returns. It's about risk adjusted return. While small and mid cap looks great during bull run, they fall significantly during adverse situation. And majority of retail investors do not have the appetite to take that volatility. And that's where some exposure to large cap companies provides stability to portfolio in case of market volatility. So first company in large cap space is ICICI Bank. ICICI Bank is consistently showing very good performance in last few years. In Q4, its deposit has grown at 14% year-on-year, advances has grown at 13.9% and net profits have grown 18% year-on-year. Bank's asset quality has remained top-notch with net NPA at 0.39%. Although due to recent rate cut by RBI, ICICI Bank might face NIM pressure unlike NBFC, like affordable housing where rate cut by RBI is actually beneficiary. And it's very important to understand the difference. The reason is RBI has mandated banks to link retail and MSME loans with repo rate. It means if repo rate goes down, banks also have to reduce the interest rate on loan. But NBFCs are not required by RBI to link repo rate with lending rate. In fact, NBFCs benefit from rate cut because they can borrow money at lower rate and can continue to lend money at same higher rate without reducing the interest. So large cap banks like ICICI may face pressure on NIM in short term, but broadly in medium term, this rate cut would result in more demand for loans and hence more business. Plus the valuation of ICICI Bank are still decent at price to book of 3.2. Yes, it may not generate extraordinary return in next 1 year, but you can expect decent performance of up to 20% upside. Then second large cap company with very good performance is Mahindra and Mahindra. As discussed in previous video also, Mahindra and Mahindra is one of the top performer in four-wheeler segment. While overall auto industry has faced slowdown in FY25 after a fantastic growth in FY23 and FY24, Mahindra and Mahindra continue to outperform even in FY25. And the key reason is its fantastic product pipeline. Mahindra and Mahindra only focus on SUV segment in passenger car category, and over the last few years, it has delivered exceptional vehicle including Thar, then recently launched Thar Rocks, XUV700, Scorpio and today Mahindra and Mahindra command 22.5% revenue market share in SUV segment of India. Not only that, its recently launched EV vehicle have received a stellar response with more than 30,000 booking on day one. On top of this, Mahindra and Mahindra is also firing on its second engine, which is tractor division. Mahindra and Mahindra command 43.3% market share in Indian tractor division, and this segment has witnessed excellent improvement in margin by 210 basis points. At the moment, Mahindra and Mahindra command a PE of around 29. That looks fair considering the order booking, product pipeline and leadership company commands in India. Hence, Mahindra and Mahindra stock should be able to generate 20% kind of return within a year. Now, as far as long-term picture is concerned, the car market in India is still underpenetrated. It's a structural growth story. Although auto sector is always volatile, so you need to keep this in mind. The only risk apart from cyclicity is competition risk. Car market in India is highly competitive with not just Indian brands, but also Korean brand Hyundai that also cater to same target audience like Mahindra and Mahindra. Although there are also German cars like Audi, BMW, but their target audience is affluent segment. So they are not into direct competition with Mahindra and Mahindra. There are also talks about entry of Tesla in India, but I am not much concerned about Tesla. I am more watchful of entry of Chinese car players like BYD, where there were rumors that they have announced the manufacturing in India. Later BYD rejected this news. Chinese companies like BYD have much superior technology and they price their car at much reasonable level. So there is a risk. But I'm sure Indian government would not let Chinese car maker disrupt Indian auto manufacturer. Commerce Minister Piyush Goyal has rejected entry of BYD in India for now. Apart from these companies, Gravita India has also posted excellent results with 13% volume growth in Q4, 20% revenue growth and 38% PAT growth. Gravita India valuations have fallen from the high PE of 70 to now at 45. But the valuations are still not cheap. Having said this, Gravita India has shared a vision of FY25 where it intends to grow volume at 25% CAGR, focus on new recycling verticals like lithium, steel, rubber and paper, and targeting profit growth at 35% CAGR rate with 25% ROCE and 50% contribution from value-added products. If Gravita can achieve even 75 to 80% of its target, there is a long runway of growth for the company. And the fact that recycling sector has a very strong tailwind. I have already discussed recycling sector in India. It's a must-watch video. Okay, let me not stress this video further. I just want to conclude that Indian stock market has seen a decent correction from 2024 highs. Still, majority of high growth companies are trading at premium valuation. But at the same time, Indian retail investors have become very mature and their disciplined SIP and even buy on dip strategy is working well. So I don't expect a sharp decline. Indian market would continue to command a premium valuation. At the same time, I don't expect a massive rally. It is the time to stay selective, not aggressive. Focus on consistent compounders with solid earning visibility, but don't chase momentum. If the broader market corrects due to global uncertainty or election noise, use that as an opportunity to accumulate quality. Because ultimately, wealth is built not in the noise of quarterly results, but in the discipline of long-term ownership. Thank you for watching this video. If you find it useful, do share it within your circle. To know more about free AI workshop, do explore the link in the pinned comment. I'll see you next video. Till then, take care.